Hello and thank you for joining us. With me today is Neil Mitchell, Senior Portfolio Manager for the Fiera Atlas Global Company Strategy, bringing us over 15 years of industry experience. Welcome, Neil. And I would love to dive into the more practical aspects of portfolio management. Could you speak to us about how you build a portfolio?
Well, we are stock pickers, and therefore, unsurprisingly, we build our portfolios from the bottom up. And we do this because we genuinely believe that whether we're successful or not will principally be determined by the types of companies that we own. And so if we can be successful in building a portfolio of only exceptional companies, these are companies that can compound up cash flows at above average rates for a very long time and in a more predictable fashion, then we put ourselves in the best position to deliver on that mandate, both the return and the risk side. And therefore, for us, it goes without saying, we should only consider these exceptional companies and not a benchmark when building our portfolios. Indeed, risk for us means something very different to how we might be positioned versus a benchmark.
Interesting. If you don't take a benchmark into consideration, how do you think about risk and diversification?
Well, we can split risk into two broad categories. The first being stock-specific risk, and we've got various ways we can assess and quantify and ultimately rank the portfolio on that basis. The second is to take a more top-down approach and to try and understand any risk exposures we might be running at our portfolio level. And it's here that we think that that traditional view of thinking about risk relative to a benchmark really falls short. We're much more interested in trying to understand where and with whom our companies are doing business with, rather than where they might choose to domicile or what type of product and service they're selling. So take, for example, software companies, where a traditional view of sector risk would tell you that the majority of software companies are giving you a very similar risk exposure. But we have a company selling CRM and R&D solutions to global pharmaceutical companies. We have a company selling design and optimization software to oil and gas and chemicals companies all over the world. And we have a company selling ERP solutions to solely Japanese enterprises. They all just happen to sell software to solve a particular customer problem, but those long-term cash flow journeys are very independent on one another. The way that we therefore go about it is to try and understand our company's cash flows by geography and end market. And so we take the big economic pie and we break it into its major components of consumer expenditure, government expenditure, business investment. And what we're trying to understand is any trends or end markets we might be exposed to that lie underneath. So for example, companion animal health within consumer expenditure. This gives us much better insight into the intended and any unintended risks that we might be running. So take our China consumer exposure, for example, where that traditional view simply wouldn't quantify this for us. But we now have good line of sight and we can assess whether we're comfortable with it or not. So diversification for us really means diversifying those long-term cash flows. And the way that we go about it is to distinguish between where we actually earn our economic rents versus where a company might be bucketed by domicile or sector.
Fantastic. Thank you so much for joining us today, Neil.
Thanks for having me.